All right, let's dive in. Today we're tackling two ETFs that have been making a ton of noise, YMAX and YMAG. Why? Because they're promising this massive weekly income. But the big question we're going to answer is that income really worth the risk?
You know, if you're an investor, the search for cash flow from your portfolio, it just never really ends, does it? And the idea of getting paid every single week, well, that's pretty tempting. And that's exactly where these two funds, YMAX and YMG, step into the spotlight. They've basically been built to answer that call for high income with advertised yields that, honestly, they make you do a double take. I mean, just look at this. YMAX's recent trailing distribution yield has been floating around a staggering 65%. Yeah, you heard me right, 65. And its sister fund, YMAG, it's not exactly a slouch either, clocking in at around 48%. Numbers like these are pretty much impossible to ignore. But whenever you see yields this high, you have to ask yourself the most important question in investing. What's the catch? Because with numbers this big, there is always more to the story. So let's get into what's really going on under the hood. To really get a handle on the risks, first, we've got to understand the engine. I mean, how on earth do these ETFs generate that much cash? It's time to peel back the layers. Okay, so the first thing you need to know is that both YMAX and YMAG are what's called a fund of funds. That means they don't go out and buy stocks directly. Instead, they're kind of like a wrapper, and inside that wrapper, they hold a whole collection of other, more specialized YieldMax ETFs. Now, all of those funds they hold, they use the same core strategy. It's called the synthetic covered call. I know it sounds complicated, but the goal is actually super simple. Generate cash by selling options contracts. What they're basically doing is trading away potential stock price gains for immediate cash, which is called a premium. So it all really boils down to this three-step dance. First, the funds use derivatives to act like they own a stock, say Tesla or Apple. Second, they sell call options against that position. And third, they collect the cash premium from selling those options and they pay it out to you, the investor, every single week. Okay, so now that we know how this income machine actually works, we can get to the main event, YMAX versus YMAG. Because even though they use the same engine, they're pointed in totally different directions, and each one comes with its own unique flavor of risk. And wow, the differences are pretty stark. YMAX is casting this really wide net across all sorts of sectors, while YMAG is making a super concentrated bet on just the Magnificent Seven tech stocks. And that one choice, diversification versus concentration, that's what really defines everything about their different risk profiles. So let's zoom in on YMAG. Its whole game plan is simple and clean. It only holds the YieldMax funds tied to Apple, Amazon, Google, Meta, Microsoft, Nvidia, and Tesla. That's it. It's a pure bet on the volatility of the biggest names in tech. And the risk? Well, if those 7 stocks all stumble at the same time, this fund is going to take the hit. Hard. YMAX, on the other hand, is like the sampler platter at a restaurant. It spreads its bets across a much wider menu. So yeah, you get the big tech names, but you're also getting exposure to things like gold miners or crypto-linked stocks like Coinbase. This spreads the risk out, sure, but it also means you're taking on totally different kinds of risk, like the ups and downs of commodities or crypto. And now we've got to talk about the price you pay for that income. The yields are flashy, no doubt, but they come with some significant, unavoidable risks. And understanding these is absolutely non-negotiable before you even think about putting money into funds like these. So here it is, the fundamental trade-off with any covered call strategy. Your potential gains are capped. If the underlying stocks just rocket to the moon, you miss out on most of that awesome rally. But, and this is a big but, if the market drops, you feel the full pain. There is zero protection on the downside. Let this one sink in for a second. Those weekly checks you get, they feel great. But that options income is almost never enough to offset a really deep drop in the market. Make no mistake, these are not defensive holdings. So we know the income comes from selling options, but there's actually another, trickier source for that weekly payout. And this is a detail that a lot of investors miss, and it's absolutely critical to understand. It's called return of capital, or ROC. And we need to be crystal clear about what this is. It is not profit. It's not a dividend. It is the fund literally handing you back a piece of your own money. So while it might feel like income when it hits your account, what's really happening is it's chipping away at your initial investment over time. Just take a look at a recent distribution from YMAX. Over half of the cash payout 56% of it was just return of capital. That means more than half of that income was just the fund handing investors their own money back. And the risks don't stop there. The fund managers are very clear that these distributions are not guaranteed. They can be cut, or they can even go to zero. And you always have to remember that weekly payout is not your total return. If the fund's price drops more than the income you get, you're still losing money, plain and simple. So after all that, what's the big takeaway? Well, it's not really about which fund is better. It's about understanding the unique risks of each one and deciding if either of them has any place in your portfolio at all. This really leaves you with a very clear choice. Putting money in YMAG is a concentrated, high-conviction bet that the Magnificent Seven stocks are going to stay volatile. Putting money in YMX is a broader bet that that same kind of volatility is going to exist across a whole range of sectors, from tech to crypto to commodities. Look, if you're still considering these funds, please treat them with caution. Think of them as small, speculative positions, definitely not core holdings. And most importantly, ignore the flashy yield and track your total return. That's the income you get plus or minus whatever happens to the fund's price. Ultimately, it all just comes down to one question. Is the promise of that weekly income really worth the very real risk of watching your capital just erode over time? That's the trade-off at the very heart of these ETFs, and it's a decision that only you can make.